In late 2008, the global financial system was collapsing. Banks were failing, credit was freezing, and Wall Street hedge funds were desperately scouring the wreckage for any possible way to turn a profit. They found their targets in the bleeding automotive industry. Car sales had cratered, and traders assumed these legacy companies were headed straight for bankruptcy. So they decided to aggressively bet against them using a mechanism called short selling. This flowchart shows how that mechanic actually works. When you short a stock, you borrow a share you don't own, sell it immediately for cash, and replace it with an IOU contract promising to buy it back later to return to the lender. If the stock price goes down, you buy it back cheap, return the share, and pocket the difference. But there is a terrifying structural flaw built into this equation. If the stock price goes up instead of down, you are legally forced to buy it back to close out your loan, no matter how high the price climbs. A normal investment can only go to zero. You only lose the exact amount of money you put in. But shorting a stock exposes you to limitless, infinite downside. At the time, Volkswagen looked like a textbook victim. It was a massive, expensive legacy car manufacturer caught in a rapidly shrinking economy. Predatory hedge funds piled in, borrowing and selling shares until they had collectively shorted over 12% of the entire company. These institutional managers were completely certain the company's value would drop. They were so confident in their collective bet that they forgot to check if anyone else was playing the board. While Wall Street was loudly mocking the German auto sector, Porsche was quietly entering the market, operating entirely in the shadows. By legally owing 12% of the total supply to their lenders, the hedge funds had unwittingly built a massive coiled spring. They were entirely exposed to anyone who could manage to capture the underlying supply of shares. Porsche had spent years nursing a specific ambition. They wanted to take full control of Volkswagen. If they had simply walked onto the open market and started buying millions of shares, the sudden demand would have spiked the price, making the takeover too expensive to execute. Instead, they utilized an incredibly sophisticated, perfectly legal financial loophole. They approached major international banks and quietly bought instruments known as cash-settled options. To any outside observer, these options looked like simple side bets on whether the stock price would go up or down. But buried in the contracts, they gave Porsche the hidden right to legally claim the actual physical shares whenever they chose. A beat of realization. This created a bizarre double reality. While public hedge funds were aggressively borrowing and selling shares, Porsche was anonymously scooping up the rights to nearly every physical share in existence. On Sunday, October 26, 2008, Porsche decided it was time to spring the trap. They issued a calm, casual press release announcing they now controlled a dominant stake in Volkswagen. To understand what that announcement did to the market, look at this pie chart representing 100% of the Volkswagen stock supply. By law, the German state of Lower Saxony permanently held a 20% stake. They would never sell. That portion was off the table. Now, subtract Porsche's newly announced, legally secured stake of 74.1%. The remaining math is terrifying. There was only 5.9% of the total share supply actually left floating on the open market. Wall Street hedge funds legally owed 12% of the entire company to their lenders, but only 5.9% of it physically existed to be bought. Porsche had perfectly cornered the market. The next morning, the opening bell rang, and the sheer impossibility of the math hit the financial system. Absolute chaos erupted. Every short seller realized simultaneously that if they didn't secure those few remaining shares immediately, their funds would be destroyed. This forced a catastrophic feedback loop. As they desperately outbid each other to buy the remaining supply, they forced the price up even higher, triggering even more panic. Over the next 2 days, the price of Volkswagen stock exploded from around €210 to over €1,005 a share. For a brief, surreal moment in the middle of a massive global recession, a struggling German automaker became the single most valuable company on Earth. That astronomical valuation had absolutely nothing to do with how many cars Volkswagen was selling. It was driven entirely by the desperate forced buying of mathematically trapped billionaires. When the dust settled, the financial damage was staggering. A handful of aggressive hedge funds were completely wiped out, losing over $30 billion in a slaughter that became known as the Bleeding of Wall Street. This event lays bare a harsh reality about investing. The stock market isn't always a clean reflection of a company's underlying health. Sometimes it is purely a game of raw mechanics, liquidity, and mathematical leverage. This is exactly why you should never participate in financial games, where your potential loss is infinite. When you leverage yourself against the mechanics of the market, you can be wiped out by variables you didn't even know existed. While the mega-rich gamble in high-stakes, opaque operations, the smartest path for the everyday investor is to step out of the casino entirely. Anchor your wealth in transparent, unleveraged assets and let time do the heavy lifting for you. You don't have to outsmart market math to secure your future. The exact tools, platforms, and blueprints to build a secure, inflation-proof financial fortress are linked in the description below. Take control of your money, respect the math, and start building real wealth today.